Dear INSEAD alumni and friends, it's a pleasure to see so many of you join this very first webinar this year. Our minds are naturally wondering what 2025 may bring. There's so much going on, from physical wars to revolutions in the AI and technology space, to major shifts in the geopolitical landscape. There's definitely a lot of uncertainty, and who better to explain to us the key trends and how they impact the world economy in 2025 than Antonio Fatas. My name is Anif Ensman. I'm an MBA 01J and the Executive Director of Alumni Engagement and Learning here at INSEAD. A quick look at the etiquette. The webinar is recorded. We want to be this webinar as interactive as possible with 3,000 people on the call. So please put your questions in the chat. This is from where we will pick them up. And also you can upvote questions of others who have asked questions. I am super pleased to introduce now to you Franz Blom, who is joining us again as a moderator. He's an MBA 09D and the president of the INSEAD Alumni Association. Also, a very, very warm welcome to Antonio Fatas, who is doing this webinar for us for the fifth time already. There's no introduction needed, but for those of you who do meet him for the very first time, he's a professor of economics, has received this PhD from Harvard and is consulting, among others, the IMF, the World Bank, the OECD, etc. Antonio, we're super curious, super grateful. Over to you.
Thank you. Well, it's a great pleasure to be here, as I've been doing for the last years, trying to get a sense of what is happening or what will happen over the next year. This is going to be a difficult year for me to make a forecast or even to think about scenarios, because I think we're all facing an incredible amount of uncertainty. In fact, I didn't realize when we planned this webinar for today that it would be right the day after the inauguration of the new US president, which happened yesterday. So I was thinking that maybe I will need a crystal ball for this seminar or for this webinar, but I realized that what I needed about 24 hours ago is my reading skills to be a lot faster to go through all those executive orders that were signed yesterday. So I'll do my best to keep it current, but it was sort of like a few hours of a lot of information coming to me and to all of us. Now, I do want to start maybe not obsessing too much with what happened yesterday in the US and with the newest US president, by taking a little bit of a global view and talk about countries that sometimes we don't talk enough and might be at the core of what the world economy is about. So let me start showing you a chart that sort of brings emerging markets to the forefront of what growth is in the world. If you look at world growth, so annual growth within a given year for the last 24 years, if you split sort of the contribution of advanced economies versus emerging markets, you will see that the world is mostly dominated by emerging markets. If you look sort of like the pale blue part of this chart, the column, you can see in particular in recent years, the last 2-3 years, emerging markets account for maybe 75% or 70 to 75% of the world growth. Now, we forget that. We forget many times that there are lots of emerging markets that collectively represent the majority of the growth we see in the world. Of course, we still need to talk about everyone else because the world is interconnected, so what might happen in advanced economies might affect emerging markets very heavily. And today, when I talk about advanced economies, I'll talk a lot about the consequences of other countries. But I want you to remember that when we think about growth for 2025, the majority of growth in the world will end up coming from those markets. Now, the logic is simple. Those markets are larger in terms of population. In some cases, China and India much larger than everyone else. Those countries are growing fast because they're catching up, they're converging, some faster than others, and that is creating growth opportunities that, of course, we don't see in advanced economies. Now, I do like to make a little bit of a regional distinction between different emerging markets and developing economies. So if you look at geography, if you look at continent, it is a fact that the world is still dominated by Asia. So if you look within the group of EMDEs, Asia dominates sort of this contribution to world growth. So if I decompose the previous number by region, this already accounts for 80% of what I've shown you a second ago. If you add the other regions, there's lots of little boxes here, but they're all quite small. And once again, if you focus on the last 2-3 years, you see a number which is dominated by the dark blue color, which is what emerging Asia represents. Now, if I look at 2025, if I look at 2026, we expect sort of a similar split when we look at growth rates across emerging markets where Asia still dominates. Not a surprise, Asia is larger in terms of populations than the rest of the other emerging markets. Asia is doing a little bit better, or in some cases much better, when it comes to that convergence toward the advanced economies. Now, if I now sort of shift a little bit towards advanced economies, let me talk about a topic which I have appeared in most of my previous webinars, because it's a topic which is fundamental when we think about growth, which is the role of technology. Now, typically I've been on the pessimistic side. When you look at technology over the last decades, we've seen technology not delivering enough from a macroeconomic point of view. In particular, productivity growth was slowing down, more so in advanced economies than emerging markets, but advanced economies are at the edge of the frontier where you're supposed to see sort of the fruits of innovation. Now, as we speak, we see for the first time in many years, maybe some light at the end of the tunnel, and we start seeing productivity growth being much faster than what I've seen in previous years. Now, you can see in my title, not everywhere. So let me highlight sort of two blocks of advanced economies, one country, the US, and then a block of countries, the Euro area. Now, unfortunately, the Euro area does not show that. Here I've split the data into two blocks, one that starts sort of right before the global financial crisis and goes until COVID 2019, one that goes from the beginning of COVID 2019 all the way until today. Now, as you can see in the Euro area, the number of productivity growth, this is measured as GDP per hour worked, has been declining, and not only has been declining, but has been very low for all this period, for all these 24 years, from a number which is clearly below 1 to a number which is not that far from 0 today. Now, where I see the revival of technology and productivity growth is very much in the US, where not only already we were seeing numbers that were significantly higher than in Europe. In my first block, you see a number which is more than double. In the last 4 or 5 years, we've seen a number which is maybe 5 times more or even more than the European number. And that number is now above 2%, which is a number that starts looking like some of the best decades, some of the best episodes we've seen before with productivity growth. Just to give you a comparison, during the internet years of the mid-1990s to the mid-2000s, we saw a growth rate of productivity of around 2.4%, which starts looking very similar to what we've seen in the last 5 years. Now, some of this is confirmed by some anecdotal evidence that we all have about new technologies, in particular, obviously, artificial intelligence, sort of delivering productivity gains within a company across certain tasks. And there's lots of studies that I've been doing today. They're sort of very micro. They don't talk about the macroeconomy as a whole. But if you combine those studies with some of the numbers you see here, we start getting into a more optimistic view of technology. Unfortunately, not global enough, unfortunately not reaching certain regions like Europe. Now, if you look at the European numbers here, you immediately think about sort of the need for a reflection in Europe to try to boost our productivity numbers. Now, that reflection is happening. The European Commission asked Mario Draghi for a report to understand how Europe can go back to higher productivity growth, in particular, reduce the gap that we see with the US. Now, that report was released not long ago. It was, in some sense, another whatever it takes moment in Europe. Now, for those of you who don't remember, Mario Draghi, when he was president of the European Central Bank, dealt with a very serious crisis in 2012, and he made this very strong statement, I'll do, as a central bank president, whatever it takes to save the euro, to save the economy. Now, this felt a little bit the same. Mario Draghi, in this case, has written a report which is very pessimistic on one hand. It talks about all the things that need to be done, but it's also very ambitious and sort of brings to Europe some of the things that need to be done to make sure that Europe goes back to growth, which is consistent with the potential, but also with what other countries have done. Now, it's a report that is very long. For anyone who cares about Europe, I recommend that you read at least the executive summary, maybe the whole report. I'm going to summarize in a couple of bullet points where that report goes. Obviously, the most important message of the report, Europe needs to invest in its future, but it needs to invest in many areas, from technology to health, to defense, to education, to climate. Now, these are all fundamental issues that Europe faces. As you can see by my long list, you can see immediately there's an issue here maybe of priorities. So I think first there needs to be a common understanding that this investment is necessary. There needs to be the resources to do that investment, but there's going to be at some point a need to set priorities. Otherwise, it's very hard to imagine Europe being able to mobilize enough resources to deal with all these needs. At the same time, the report also makes a point which is fundamental for Europe. Europe has benefited enormously from the single market. That is not done. That is not done in certain areas. So there is a need to push the idea of a single market beyond what it is today, in particular in capital markets, which is very much connected to yet another recommendation, which Europe might have to learn from the US model of funding, in particular funding a startup, funding new ideas, funding innovation, because clearly the model of the US seems to be much better at building those new startups. If you look at sort of new companies, if you look at unicorns, et cetera, the US has dominated Europe, and one of the potential issues that Europe has faced is a capital market that does not have the same appetite for risk, and it doesn't have the same environment to deliver that funding to that risk. Now, in this context of sort of low productivity growth in Europe, Europe faces sort of two potential malaise. One is the productivity growth not growing, but the other one is one which I've also brought up in previous webinars often, which is the issue of demographics. So if productivity is not growing and demographics are going in the wrong direction, then the potential for growth is really limited. Now, demographics are going in the direction that they're going because population is shrinking in some countries. Population is aging in most European countries. And here I want to bring up one issue which has been there in the agenda now for many years, but at the same time that is in the agenda is one of the most complicated issues from a political and social point of view, which is the issue of migration. Now, when it comes to migration, I just want to show one number to give you a sense of magnitude. If I look at recent years, I'm looking at 2019, again, pre-COVID to 2023. If you look at change in employment in European countries, and you ask, what is the percentage of that employment growth that comes from people who were not born in these countries? So these are people who migrated to these countries. It might not be in those 4 years, but it might be sort of in recent years. If you do those numbers for Europe as a whole, the European Union, and a few countries individually, you see these are really large magnitudes. The European Union is already 80%. So 80% of the jobs created in these 4 years have gone to people who were not born in the European Union. If you do it country by country, you might see numbers which are even more spectacular, numbers around 100%. Now, what does it mean above 100%? It means that the local jobs, or sort of the jobs that go to people who were born in that country, are in fact decreasing. So there's negative employment growth. If you look at sort of domestic conditions, employment is only growing because there's enough migration to keep the numbers at a positive level. Now, for those of you who've seen some of my previous webinars, this is not going away. In fact, it is likely to accelerate as time passes. By accelerate, it means that we're going to have more of that demographic transition, more of that aging, more of that population shrinking in some countries. So the need to think about migration in a strategic way, in a way that works, both economically but also politically and socially, seems to be more and more fundamental for Europe. Now, I have avoided so far saying much about yesterday's presidential inauguration in the US, but I'm going to have to bring it now here. Of course, another big issue that is in our agenda for 2025, but also for the next many years, is the question of tariffs. So the new US president is clearly very much in favor of tariffs, has talked about tariffs many, many times. So a relevant question that I saw many of you asking as you were signing up for this webinar is, what is happening with tariffs? What is the consequences of the world? Now here I face a very difficult issue, which is I'm not sure which numbers are we talking about. Trump originally started talking about numbers that look like this: 10% across the board, everyone, every sector, every country, 60% for China. Now, those are very large numbers, and those are very broad numbers. In 2018, when we talked about a China-US trade war, we were talking mostly about China, and we were talking mostly about certain sectors. So very targeted tariffs. Now, today we're talking about across the board 10% for everyone, 60% for China. So this is a serious escalation of tariffs. But you have to add to this the retaliation of the other countries, which is uncertain. What would Europe do? What would Latin America do? What would Canada do? If you keep raising tariffs on both sides, then we're not talking about 10, we're talking about much larger effects, much larger numbers. Now, it gets more uncertain for all of us who are looking at these numbers. At some point, the 10% turned into a 20% in another speech by Trump. So now we're talking about even bigger numbers across the board for all countries. If you happen to be living in Canada or Mexico or coming from there, you probably are aware it's not 20, it's 25%. So yesterday, Trump suggested that in both of these countries, tariffs will be 25% in about 10 days, starting in February 1st. Now, when he says that, it starts sounding as conditional on some negotiation. So will it happen? We're not going to have to wait those 10 days. Now, it gets even worse. If you are coming from a BRIC country, these countries have the threat of having tariffs of 100% if they insist on trying to create an alternative to the dollar, which is a project of these countries. So here you can see the range of tariffs is enormous. So thinking about effects really depends on the scenarios. Is it 10 or is it 100? 10, you might say it is manageable. It's not positive effects, but it's manageable. Of course, anything that gets to 25, 60, or 100, and anything that gets into retaliation from other countries would have economic consequences that will be a lot larger. Now, let me just say a couple of words about what tariffs imply for the world economy. I don't think this is a mystery, but sometimes some people seem to forget. A tariff is a tax paid by US consumers. So if you are sitting in the US, you're going to pay higher prices through a tax. It's like a VAT increase. That's what a tariff represents. If it's across the board, it means anything that you import is going to have a tax. That is something which is obvious. Any country which is not the US will be affected because you're now exporting to a country that has put a tax. Therefore, your goods are more expensive. Your exports will fall. Your activity will fall. Once again, how much? If it's 10, not that much. If it's 100, it will be a significant effect on export, which will have a major effect on countries whose exports to the US are very large. And finally, something which is long-term, it might not do much to 2025. We're engaging into a process where we're going to distort and possibly undo some of the globalization we've done before. So production is not going to go to the places where it should go. Production is going to go to places which are determined by some politically determined tariff. Now, this means inefficiencies. This means, from my point of view, sort of lower growth rates going forward. This is not for 2025, but again, it's bad news when you think about the world. Now, let me give you a number that goes with that. We've already done some of these, and we've already seen some consequences. Now, in 2018 was when the trade war between China and the US started, again, under the first presidency of Trump. Now, if you look at the trade between China and the US, so these are going to be imports in the US coming from China or exports from China to the US. You can see them growing until that date. And since then, they've been falling by almost 20%. Now, these are nominal numbers. They're not adjusted for anything. So they should be growing all the time. So don't expect them to go down often. So you can see a significant effect in trade. Now, interestingly, that trade went to other countries. So if you were a company in China, you avoid sort of the tariffs by putting your location, your production in Mexico, by putting your production in Vietnam. Now, that is sort of okay, although you might end up in places that are more expensive and less attractive to you or to the consumers. Now, when we talk about tariffs everywhere, do not expect to see much of these because there's nowhere to run. So we're going to talk about something very different, which is sort of a slowdown or decrease in trade across the world. That's going to have much larger consequences than what you see here, which is a little bit of a trade diversion from one country to another. Of course, this affects China. It affects Mexico possibly in different ways. That's not what we're seeing right now, what we're thinking right now. Now we're thinking about tariffs across the board. Now, I'm going to say something very quickly about geopolitics. We could spend hours talking about this slide, but I'll just say it very fast. Of course, something else is happening, I think, as we speak. The combination of different forces around the world, I think they're leading to a weakening of institutions, the weakening of rule of law, more in some countries than others, the weakening of democracy in some countries. From my perspective, this is bad news for growth in the long term. You might not see much effect in 2025, but institutions are key to growth. We're moving into a world which is transactional when it comes to politics, when it comes to international relations. That's not the world that we've lived in. Of course, there was always negotiations. These negotiations are coming to an extreme. To me, this opens the door for a lot of uncertainty about decisions, what is going to happen. A lot of uncertainties about alliances within a country. So we're seeing some weird alliances politically within countries, and of course across countries. Who's your friend? Who's not your friend? Who do you want to be nice to? So I think we all understand, I don't want to spend a lot more time about this, that anything that is at the geopolitical level, we're looking at increased uncertainty, deterioration of institutions. Again, I think that's bad news for growth in the long run, even if we don't see a lot of that in the coming quarters. We're going to do a little pause now, and we're going to do a few questions. Franz is coming on board, and I'll take a few questions, and then I'll say a few more things more about what is happening in the short run. I'm not going to talk about trends anymore. I'll talk more about sort of current events. Franz.
Excellent. And thank you so much, Antonio. It's I mean, a tour d'horizon as always to get us going. Let me double click maybe on one or two points that you made in this first block, and then also move to a couple of questions that have been coming up through the chat. But let me start with the point that you made where Mr. Draghi has pointed out that the European Union needs to obviously make huge investments to become way more productive. And I think you quoted a number that he mentioned, around 800 billion in investments that were required. But if I add that up next to what we need to spend on preventing climate change, which is in the order of magnitude of 2% of GDP, we want to strengthen our defenses. I mean, we're talking now about 3% plus, so that's another 1% on top. There's the care and cure explosion that we see happening, another roughly 3 percentage points in the next decade. There's the pension obligations in many countries that are increasing. They add another 3% of GDP in the next decade. I'm easily adding up 8, 9, 10% of GDP that we need to start spending on elements that we're not spending them on today. How realistic in democracies is it that we're going to spend this money?
I mean, I don't think it's realistic that we're going to find the money. I think there's a question of resources. I think you're very much right. If you add up all these things, they're just too large to think about a scenario where those resources will be available from a political, social, or economic point of view. Again, there's two ways to find resources. That productivity growth accelerates, that gives you more resources. So that's partly what Draghi is trying to address, but it's a challenge. I would not say that this is a done deal. I think it's a challenge. The second issue is back to immigration. Again, the ability to keep attracting people to Europe so the economy keeps growing, and that gives you resources, both in terms of GDP, but also in terms of tax revenues, of course. But I think to be realistic, I think we're not going to make it. We're not going to make it in terms of as many resources as we need. So I think there's going to be very, very complex and deep conversations about priorities. Again, what do we do? Do we keep the pensions at the current level, or do we invest in defense? Do we invest in climate change, or do we invest in technology? And these are difficult conversations. If we were a company, these are going to be a lot more difficult conversations because we are countries, and in the case of the European Union, a collection of countries sometimes deciding on the common goal.
Yeah, wonderful. Let me move to two sets of questions. I mean, I'll take the top one voted, and that's the question what the benefit is for Mr. Trump and his family to actually support crypto and actually launching their own crypto last weekend, where they have the reserve currency in the US. And is that not undermining the US dollar position as the global reserve currency in the midterm?
I mean, I think there is, again, if I take a step back, not just thinking about what Trump has done in terms of crypto, I mean, I still think that sort of cryptocurrencies have not delivered the promise that they had in 2008 when they were created, Bitcoin. I think they've become sort of an investment vehicle for some people, a way to make money for others. And there's obviously growing interest now that the US seems to have this relaxed attitude about cryptocurrencies. I don't expect the world financial markets to move into cryptocurrencies. I do not expect consumers to start buying things in cryptocurrencies in the short or in the medium term. So I don't think that will change. I think there's going to be a world of sort of investment. Let me use a word that sounds negative, and it is speculation that is going to grow when it comes to cryptocurrencies. I think this is bad news because I think it's going to create volatility. The bigger this is, and the less we regulate it, the less we understand it, and then we'll find it ourselves in a crisis, and we'll say, let's blame the regulators, let's blame the central bank because we didn't do enough. Again, we did that in the global financial crisis with other financial instruments, which are not cryptocurrencies. Now, why is Trump doing this? I think because he found support in that group. He needed support from as many people as possible. Some of these people now are very close to him because somehow he's managed to attract people coming from the tech world. They seem to be making a difference for his ego, but also for the funds that he has. Again, it's an alliance which I don't think is in the benefit of the US or the rest of the world. But yes, I think we're going to see a little bit of an explosion in this world for sure over the coming years.
Wonderful. And then I think for this block, maybe the final set of questions is very much around, I mean, we talked about the growth coming mainly from Asia. I mean, GDP growth, that your starting point. I think there are a couple of questions around how reliable are the numbers, especially given that, well, there is China numbers in there that people not always trust. So how reliable are the numbers? But B, also, if we think about indeed the tariffs, the trade wars, what will be the impact on Asia as a region specifically? And are there also ways to think about it where actually it might strengthen the ties? I mean, getting these tariffs in place and getting the trade wars in place with the US, would that strengthen ties between other blocs around the globe? Because it's, of course, you can think about the all bilateral deals that Mr. Trump would like to make, but it could also be that if other people actually stick more together, that it strengthens the ties between them. I mean, there's a couple of, maybe you can reflect a bit on Asia as a region, I think.
I mean, I don't worry too much about the quality of the data. I'm not saying that the Chinese growth rates are 100% accurate. They're not, and I can see occasionally that they surprise me and they're suspicious. But the type of magnitudes we have in Asia, they're not going to go away even if the data was measured a little bit better. I think really Asia has shown over many years that they're very good at growth, and they're very large. Population, the majority of population live in Asia. That shows up in the numbers when you do the math. I think the tariffs will affect Asia, but the problem is this time the tariffs, in theory, again, everything is a theory here, they're across the board, right? If there were only tariffs on Asia, I would say, okay, if I'm a company, I'm going to try to move to Mexico because I might reach the US better than if I'm in China or in Vietnam. But that's not what it is, right? Now, China might get hurt the most under the assumption that tariffs go up to 60% in China, which I don't think they will. That number is not realistic across the board. But if China was to be hurt, I think, yes, Mexico will benefit, but the rest of Asia will benefit as well, as we saw in countries like Vietnam or India, where we saw some of the production from China going there. So I don't have a lot of question marks about that forecast that Asia will dominate emerging markets and as a consequence of the world. Again, of course, we can get into some political scenarios which are catastrophic. But if you look at the economics of this, I think that's quite certain that we still see most of the growth in this region of the world where I'm currently are. I'm speaking from Singapore.
Yeah. Wonderful. I'll collect the questions for the next block and see you in 15, 20 minutes.
Okay. So let me go to the second block out of what I wanted to do. And my second block is going to deal more with sort of the immediate future. The first topics, as you have seen, the topics that matter, of course, for today. There's lots of things related to tariffs, migration, productivity, which are fundamental. But there's lots of other issues which are really hot, which are current, which is what I'm going to call sort of the risk that we have in 2025. Now, let me start first with a picture that says, maybe nothing major happens in 2025 and we're worrying for no good reason. This is a forecast that the IMF just produced, and just 3 days ago, they produced their update to the World Economic Outlook, which they do every 3 months. and they have the numbers for growth for 2024 and a forecast for next year, so not next year, this year, 2025. So if you do it in two groups, advanced and emerging markets, or EMDs, you have that the forecast for 2025 is almost identical to 2024. In fact, it's identical for EMDs, but it's a little bit higher for advanced economies. That's why I labeled this slide business as usual. Maybe there's not much uncertainty. Now, of course, this forecast assumes that nothing is going to happen, that nothing wrong is going to happen. If you read the report, they talk a lot about uncertainties, about things that can go wrong. Now, let me make two things. First, let me make a point. Again, a little bit of this forecast speaks about the success of the last years. So let me just say that in the last 2-3 years, the world has gone through lots of things, and I think it has come out quite well out of that experience. First, inflation is almost gone. I know this is a concern among some. This is not the first risk in my list. I know there is issues with inflation in some countries and the possibility that it doesn't really go down to 2% or whatever the level is that we want to, but I see inflation in most of these countries almost gone, and in some countries I start worrying about low inflation as opposed to high inflation. The other thing that we've done for 2 years is avoid recessions that many people had forecasted. 2023, everyone said a recession, it didn't happen. 2024, a recession, it did not happen. And we did that despite a very complex geopolitical environment. Again, the brutal invasion of Ukraine by Russia, a conflict, a very serious and long conflict in the Middle East. We survived that and a few other things. So here you get this notion of an economy, a world economy, which is resilient and stable. That gives that forecast of the IMF saying, okay, maybe we'll do it through another year, even if there's a lot of things that can go wrong and we have uncertainty. Now, of course, there is a but. There's certain things that really look very risky. I'm going to mention 3. 1, China and Europe are at a crossroads. I'm not going to say anything more about Europe because I talked about it before. Demographics, productivity, those are fundamental issues. I'll say something about China. Uncertain US policies. I already talked about tariffs. I'll say a couple more things about that from the announcements yesterday and a few other things. And I want to bring financial markets because there's 2 things which to me are at risk: interest rates and what is going with the stock market, in particular in the US, that happens to have by far the largest stock market in the world. It's probably 50 to 60% of the world stock market. Now, let me say something about China. China has been dealing for many years, if not decades, with the difficulty of rebalancing its economy. The government understands that investment needs to come down, consumption needs to come up, but despite their efforts, they haven't been able to do it. And some of the difficulty in managing this imbalance has led to pockets of debt in the private sector, in certain state-owned enterprises, which are too big. Now, this is a well-known issue and has worried many for a few years. Now, why is it that the risk might seem maybe larger today than in previous years? Because in China, if you look at inflation, this is just the inflation rate, annual inflation rate in China. China is toying with inflation rates which are very close to 0 or even negative, what we call deflation. Now, typically, that's a bad recipe when you have high debt. Why? Because low inflation or negative inflation hurts the debtors, makes the savers very happy, but hurts the debtors. So this is the typical cycle that, for example, the US went through the Great Depression, high levels of debt, deflation, and obviously a very large crisis. This is not different from what Japan did in the 1990s after the economy slowed down, which is very similar to what China is doing right now. Now, I would not say this is a recipe for a crisis tomorrow, but this is a serious macroeconomic situation where the government needs to address, and the government needs to make sure that the economy does not fall into deflation. So the necessity for the right type of stimulus at this time in China, I think is clear when you look at the data. That combined with a way to rebalance the economy, which is that long-term issue that they're struggling with, which means finds ways to increase consumption. Do not depend on investment, but increase consumption by making sure that the income reaches the households in China. Again, that's a necessity, which I think is much more of an issue today than it was last year, 2 years ago, or 5 years ago. So this is what I call sort of China as a crossroads. Now, when I look at US policies, I already mentioned the difficulty of understanding tariffs. I wanted to bring this sort of index of uncertainty. It's built by a few academics that look at news. So they look at news, they do some text analysis, how people refer to tariffs, trade, and they construct an index of uncertainty. What does it sound like when we read the news about how uncertain trade policy is? Now, I don't think this is a surprise. As we speak, this is done by months, but I put it in quarters so you can see it better. Uncertainty is exploding. Uncertainty today is a lot higher than it was in 2018 when we had that other trade war between the US and China. It is very likely that in the next months that number will spike even further. Now, this is not the only source of uncertainty in policies in the US. We have uncertainty about the way the US government will relate to the US Federal Reserve. We have uncertainty about government deficits in the US. So there's a set of policies which we all are uncertain about. That's not good for growth. Again, that doesn't call for a crisis tomorrow, but uncertainty will certainly delay some investments, some spending, and if it gets to a point where it's excessive, will certainly could lead to a global slowdown, and in the worst case, something that resembles a recession. Now, there's something else which, third point, financial markets. Now, interest rates, if you look at interest rates by central banks, they had to come up when inflation went up. They've been on their way down. I think they're going down at a pace which is reasonable. If you hear central banks, most of them will tell you, expect more of the same going forward. Now, I'm not worried about that. I'm worried more about long-term interest rates, which are adjusted for inflation, real. These are, in my mind, the relevant variables when you want to think about two things. Investment by companies. What is the real cost of capital? But it's also a variable which is very important for governments. What is the burden of the debt that we have, which has been increasing over time in recent decades? And it's very important for the stock market, because the stock market has to price stocks, taking into account what sort of real interest rates on bonds or the real discount rate is. Now, if you look at the evolution of this number, we went through decades where this number keep coming down. We leveled those decades in different ways. Ben Bernanke at some point called these decades the saving glut decades. There was too many people in the world saving. At some point, people thought this is going to stay here forever. And then COVID happened. Now, COVID was a confusing period for all of us. But since COVID has passed, and we clearly has already left that crisis, if you look at the numbers at the end, and now we're talking about more than a year, interest rates have stayed a little bit higher than what we thought. They're now reaching levels which are similar to 2006. Now, they're not up to the levels that they were in the 1990s. Again, we've seen worse. But what happens when interest rates go to these levels? Debt is more expensive. Stock market looks more expensive. Now, let me do a calculation for you of that. Let me start with debt. So I'm going to use the US government as an example. In a second, I'm going to tell you it's not a US story. It's a story across governments all over the world. So what is this? This is the interest payments that the US government has to do on its debt as a percentage of GDP. Now, I'm going here back to the 1960s, so you get a long-term perspective. Now, these payments were really heavy. The burden on debt was really heavy when interest rates were really high. So we're talking about 5% of GDP every year going from the government to pay for interest payments. Now, then we go through a period of time where governments love. Now, you see these numbers dropping by half. So they go to 2.5. Now, they didn't drop because the debt of the government did not increase. The other way around, the debt of the government was going up very fast. But this is the period of time where interest rates were coming down, and it made a situation of high debt sustainable. So many times, again, in my classes, in webinars like this, people ask me, how can it be that governments keep accumulating debt? And my answer was always the same, because interest rates are low. As long as interest rates are low, we are fine. Now, you've seen in my previous slides, interest rates are not that low. They're coming up, and you can see immediately in this slide the effect. immediately the US government has to pay up to 4% of GDP because of the debt, because of the interest rates are higher. Now, this number is likely to increase as we move forward, because as the debt, the old debt matures, it has to be renewed at an interest rate which is likely to be higher than before. Now, if interest rates don't come down, and assuming that debt keeps increasing, which might not be a bad assumption of, at least over the short run, governments are really going to put themselves in a position which starts being a lot more fragile when they look at markets and they say, please buy our debt. Now, here I'm going to bring two headlines. One is from today, the other one is from a few months ago. One is from the UK. This is from today's headline. I just saw it in the Financial Times about half an hour ago. So here is a warning from Ray Dalio about the UK debt spiral. The fact that in the UK, you're seeing, as we speak, increases in interest rates like the ones I've shown you in the US, but they are motivated partly by the view of the market that maybe the UK government is going to have a hard time dealing with the sustainability of its debt. We saw the same thing in France through the episode of political uncertainty during the fall and the winter. At some point, the French interest rates went above Greece for the first time in a while because of the concerns about the budget. So you have the interaction of interest rates going up, making government debt more expensive, but that leads to a questioning by markets that possibly this is not going to work well and interest rates might go up further. Again, nothing new. We've seen this many times in economics, but this is the case where now advanced economies have put themselves in a position because of the high debt that could be fragile if interest rates are still high. Now, let me make the second point about interest rates. The interest rates also affect the way we look at the stock market. Now, I do these calculations regularly for anyone who's seen me in class or in a webinar like this. I calculate the equity premium. This is the S&P 500. And the way you read it, you look at this slide, this graph, is anything that is high means that the stock market is very cheap. So I'll call it a bargain. Everything that is low, the stock market is very expensive. So I'll call it a bubble or something that resembles a bubble. Now, if you do a calculation over the last years, what do you see? You see an episode of a massive bubble in the 2000s, which is the internet boom that led to a bust in the stock market. You see an episode which is not as dramatic. Remember, low means a bubble. In 2007, before the global financial crisis. Since then, we have not gotten anywhere close to that, except as we speak. So as we speak, we have a combination of two things. The stock market has done very well over the last 2 years, but interest rates have increased, which makes this equity premium look very low, meaning that the stock market does not promise a return which is that much higher than a bond today. Now, that is problematic unless you believe earnings are about to grow really, really fast. That would always save the day. Or you believe that those interest rates are about to come down. So they're an anomaly and are about to come down. Now, I'm not saying those two things are not possible, but I do worry when the market only can be sustained under two assumptions, which are on the optimistic side. They might happen, but I wish maybe the market was pricing less of these two phenomenon, and I would feel more comfortable with the pricing of the market in that case. Right now, the market looks expensive, quite expensive, if you look at this chart. And again, you have to rely on some very optimistic views about interest rates and earnings. Otherwise, this starts looking a little bit like a trouble for the stock market going forward. So from a financial point of view, these are the risks that I see. Interest rates, how they affected the stock market. These are not minor issues that could get maybe in a more difficult situation as we look forward. Now, let me say one more thing about the US, because of course, there's lots of announcements yesterday and a few others during the campaign. Now, what are the three things that I see coming out of the US government? Of course, the list will be very long, but just to summarize, there's something which has an economic effect, the deportation of millions of illegal immigrants. I'm saying X because we don't know the number. No one does. Tariffs of Y%. We don't know the number. It could be 10, it could be 100%. And there's a weakening of institutions. Now, some of the things we know, the US yesterday abandoned the World Health Organization, at least through these executive orders. But there's other things that we don't know, sort of how much pressure the US government will put on the Federal Reserve to set interest rates differently, who will be the next chairman of the US or chairwoman of the Federal Reserve. Now, there is uncertainty here, but there's also something which we can already start speculating. So if these things happen, in particular if they happen in big magnitude, they will have a negative effect on global growth for the US, but also growth for other countries. They will create some inflation in the US. That inflation will lead to higher interest rates. Those higher interest rates are likely to lead to an appreciation of the US dollar. We've already seen some of that. How much can we see of that? A lot, if we see significantly higher inflation in the US. So exchange rates have been quite calm for the last, I don't know how many years, maybe 2 decades. This could be one of those moments, 2025, where we see large swings in exchange rates, very much driven by what is happening in the US. Now, let me just finish with some optimism. If for those of you who thought everything sounded a little bit negative today, can we see something positive? We can, although it's going to be challenging. We can see more growth coming out of technology. I'll come back to technology in this bullet point. Now, for that, we need the right context, the right regulation. I'm a little bit worried that we might not get everything right, and I want to advertise our next webinar, which is going to be with Simon Johnson, which is one of the Nobel Prize winners this year in economics, who's written a book which is exactly about this, about how governments and societies can sort of control technology so that the outcome of technology is in their favor, not in the favor of few. That's March 20. I'll be talking to Simon about this. Please show up for that one as well. Now, the other upside is Europe. If Draghi report is implemented with the right political will, there's an upside because Europe can do a lot better than we've done in the past. And finally, emerging markets. Started with emerging markets. I finished with emerging markets. They could do even better. Emerging market growth is healthy, stable, but is less than what potential tells you it can be. Now, for that, we need to think about reform. We need to think about institutions. Might not be the best geopolitical environment to do these reforms right now, but if you want to think positively, why not? Why not think about emerging markets or regions where emerging markets are, where finally we get this right? Now, let me stop here, bring Franz back, and then we'll take a few more questions until the end of the session.
Fantastic. Thank you so much, Antonio. And your talk is sparking an enormous amount of questions, which I think is good, and it shows there's desire for more. There's quite a bit around inflation and exchange rates, but I think you've tackled most of that. It's actually not surprising because I read this morning that in Davos there were 2 polls being reported both by Edelman and Pricewaterhouse that also had inflation as one of the top concerns of the participants. So it's not surprising that we also see a lot of that here. But I think you've tackled most of that in the discussion. There are a couple of other topics that we've talked about a bit less, and I'd like to touch upon 2. One is energy. Of course, also the Trump administration has specific views on decarbonization, to frack more, to drill more, to actually develop a glut of, if you like, cheap energy for the US. I think that, if I'm quoting Mr. Trump correctly, he said, we're sitting on the largest reserves of oil and gas here globally. That's the gold under our feet. We need to start using that to actually reestablish our position in the world. Words along those lines he used yesterday.
Yeah.
Any views on the energy markets? Because on the one hand side, we see a lot of investments going into electricity from wind, from solar. There's a large effort to actually decarbonize. And he's speaking about something completely the opposite. It might well be that we're swamped in cheap energy in the next year, or not.
I think if he ends up delivering what he says he will deliver, I think it might take time. I don't think it will happen in 3 months, but obviously the US can put more effort and investment into finding more oil, for sure. I think that would sort of increase the supply of oil production going forward. The US has already done a massive step in that direction over the last years. Again, Biden did not really stop that effort, despite what Trump claimed, but I think Trump could accelerate that. Again, that says in the near term, maybe not in the next 3 months, it might be that puts a lot of downward pressure on the price of energy coming from that source. I think that happens at the same time that other countries, other regions, certainly Europe, also to some extent or to a large extent, China, have been investing in other technologies that are finally paying off. Again, this is showing up everywhere in Europe. The percentage of energy coming from renewables keeps increasing. Now, it hasn't shown up yet as much as we would like on the price of energy we pay for many reasons, including a war in Europe. But again, if you put all these things together, I think as time passes, we might see, at least in the medium term, again, energy becoming significantly cheaper. Now, what Trump is doing might have really bad consequences for other areas like climate change and the transition to green energy in the US. But if you're just thinking about energy, I think the confluence of these two trends, I think they might bring us sort of cheaper energy in the near future. Yeah.
Yeah. Okay. Let me also move back to a couple of the topics that are more around geopolitics. And let's maybe start with Africa. We haven't spoken about Africa at all. Now, you could argue that's more a midterm development than necessarily a 2025 development. But even so, could you spend maybe a couple of reflections on how to think about the African continent?
Yeah, I mean, if you look at the African continent, it had a couple of years over the last decade, 10, 15 years, where some countries sort of saw the light. There were some interesting reforms, I wouldn't say across all countries, but in enough countries in Africa, that growth accelerated. Now, since COVID, I think we've gotten slightly more pessimistic. Some of those countries ended up in crisis because some of the efforts did not pay off and they had some debt crisis. The rest of the continent has not grown that much since COVID, and they're a little bit back to a steady state where growth is clearly below their potential. Now, this is sort of a little bit my last slide, meaning you want to talk about upside potential, there it is, right? But I think we know what it takes to get that going. I think it's a lot about institutional reforms in a continent where these institutional reforms are not easy, where there's no easy, good examples that can be exported to other regions, where the continent is sort of subject to some of these geopolitical forces and some of the big powers, whether it's China, whether it's Russia, or whether there are others trying to have a say on the future of the continent. So again, that doesn't make me too optimistic, but at the same time, I do want to be optimistic, and I do want to think about that as sort of one of the highlights of growth going forward for them, for the world, but in particular, obviously, for people who live in that region.
Yeah. Okay. Before we go to the last bit, which will be about stock markets and investment opportunities, maybe another question that's popping up a couple of times. We've talked about, I mean, what we can expect, what's reasonable to expect. But if we start to think a little bit more extreme, the black swans, what would in your mind be the 2 or 3 black swans that could significantly derail the global economic outlook? Because as you've shown, outlook 25 basically is the same as 24. I mean, we're saying if things are stable, that's what we should expect. What are the 2 or 3 black swans we should watch out for?
I mean, I think that there's some that are obvious, which might not be black swans, but they're like risks that are substantial to derail growth. Again, a serious tariff escalation across the world, where we're talking about large numbers, all goods or countries, retaliation. Again, that would send the world into a recession for sure. There's no doubt about it, because it's too disruptive. Even if you can say, okay, one day we'll figure it out how to live with that environment, not in 2025, that will be a recession. Now, if you want to think about bigger ones, again, I do worry about political conflict. Now, I did worry about political conflict, sort of military conflict in the first Trump administration. It didn't happen, and we didn't get close to it either. But again, times change, and the administration is different. And some of the rhetoric of the administration can be very aggressive. Today meaning yesterday in the US, so Trump was asked whether he would consider entering Mexico with the army to fight some of the drug cartels in Mexico, and he said, why not? Now, if you ask me for a probability, I don't think that's going to happen, but you just asked me for a black swan, something that has a very small probability. That's it. That's what has a very small probability that, again, we cannot even think about the consequences of a military intervention of the US in its neighbors, right? But again, that's something that one cannot rule out when the president of the US says that in a press conference.
Yeah. Or going after the Panama Canal or something similar.
Sure.
Yeah.
There's a few other targets. Yeah.
There are a few more targets. Absolutely. Absolutely. Okay. It brings me to the last two questions. I mean, one is maybe first around the stock market, and you've shown like the premium that's currently being paid on stock markets. Now, we've always learned to segment, I mean, these kind of numbers. Is this primarily driven by the Magnificent Seven? Is this, do you see the premium coming down across the different subsectors in the stock market? Could you elaborate a little bit more on that? And then maybe I'll throw in my last question immediately as well. This is the inevitable one to expect. Any advice on good investment opportunities for the year ahead? And it's read here, whether it's commodity markets, emerging markets, energy markets, anything where people should be optimistic about and allocate their savings.
Yeah. I mean, I think the stock market overall, not just a few companies, looks expensive.
Yeah.
It does look more expensive in the US than in the rest of the world. So again, if you do any sort of pricing, it looks more expensive. But even the rest of the world, again, it looks on the expensive side historically. Not everywhere, not every company, of course, but it does. It is not just the price of the stocks, it's the interest rates being substantially higher than they have been since 2006. That makes a big difference for my assessment. Now, there's no doubt some of what is going in the US is driven by the tech companies. Now, it's hard to separate that from the reality, which is these companies are the large companies for a good reason, because that's where growth is going or where growth is coming from. So it's hard to say this is the problem or this is the symptom, which says if that's where the economy is growing, you're going to see the excesses in those sectors more. It does look a little bit like the internet years, where there was obsession with the internet, now it's obsession with artificial intelligence. Those years were worse, in my view. Again, I was teaching at INSEAD already in the mid-90s. I feel that was even worse than what I see now, significantly worse. Now, other markets look a little bit cheaper. So one could say, okay, so why don't I put my money in Europe, or why don't I go to emerging markets? Again, one has to be careful because unfortunately the stock market in the US is so big that it's going to drag everything down, as it happened during the internet years, where when the stock market in the US went down, everything came down. So I'm not sure one can easily diversify risk by going to other countries. Of course, I would advise people to do it. That's wise advice. But as a macroeconomist, I also see if something goes really wrong, it goes wrong everywhere. Now, is there any good investment opportunities? Again, when asset prices are high, everything looks not great. I'm going to, I think, just make a joke because I need to finish on a light note. After this webinar, I'm going to create some cryptocurrency that I'll give it my name. I'm going to sell it, and maybe hopefully I'll be as successful as Trump, who, if his cryptocurrency is as valuable as it was yesterday, he would be now worth $50 billion more than he was before he launched it. I don't need 50 billion. I'll just be happy with just a few millions here and there.
Fantastic. Fantastic. I'll tell you, I'll certainly buy them. So, but apart from that, I want to thank you very, very much for a very insightful set of observations that you shared, starting with the background and moving into the specific areas as we just did. We had a very big crowd. I saw at the high point over 1,500 people attending and watching the seminar. I know it will be reviewable as well, so I'm sure many others will do that. And I look forward to 2025. I'll keep your wise words in mind, and I'm sure we'll have another date in 2026. Many thanks.
I'm sure. Thank you very much. Have a good year.
Okie doke. Thank you.